As we step into January 2026, silver stands at a pivotal moment in its market history. After a stunning performance in 2025, where the price surged dramatically from around $30 per ounce at the start of the year to new all-time highs above $70, and even touching $80 plus in some sessions, the white metal has captured the attention of investors worldwide. Yet, while retail enthusiasm has grown, it's the smart money, institutional investors, hedge funds, major banks like JP Morgan, and high net worth accumulators who have been quietly positioning themselves for what could be even stronger gains ahead. This isn't mere speculation. It's driven by a powerful convergence of fundamentals that make silver one of the most compelling asymmetric opportunities in today's uncertain economic landscape. Here's a detailed exploration of why sophisticated investors are accumulating silver now, before the full implications of these trends play out in 2026 and beyond. Persistent, structural supply deficits, the core fundamental driver. Silver has been in a structural deficit for multiple consecutive years, with demand consistently outstripping supply. According to data from the Silver Institute and Metals Focus, 2025 marked the fifth straight year of shortfall, estimated at around 95 to 187 million ounces, depending on the source. Following cumulative deficits nearing 800 million ounces since 2021, mine production has remained relatively flat or even declined slightly, around 835 million ounces in 2025, while recycling and other sources haven't closed the gap. This imbalance isn't cyclical, it's structural. Primary silver mines are rare. Most supply comes as a byproduct of other metals like copper, lead, and zinc. Meaning higher prices don't automatically trigger massive new output, The deficit has already eroded global inventories to historic lows, creating physical scarcity. When demand surges, as it has, prices can move explosively because there's simply less metal available for immediate delivery. China's export restrictions starting January 1, 2026. A major catalyst arrived with China's new rules limiting silver exports without permits. As the world's second largest exporter, behind Hong Kong, this policy is expected to remove tens to hundreds of millions of ounces from global circulation, exacerbating tightness and potentially triggering a squeeze in physical markets. Smart money sees this as a classic supply shock. Institutions accumulate ahead of disruptions, securing physical positions or futures contracts before retail crowds in. Exploding industrial demand, silver as the next generation metal. Unlike gold, primarily monetary, silver is 50 to 60% industrial, making it uniquely positioned at the intersection of technology and energy transition. Key drivers include solar PV, photovoltaics. Silver is essential for conductive paste in solar panels. Demand from this sector alone has surged, with consumption projected to exceed 200 million ounces annually by the end of 2026, as global capacity grows exponentially. Electric vehicles, EVs, and electronics. Silver's unmatched electrical conductivity powers batteries, wiring, switches, and charging infrastructure. Emerging tech, AI data centers, 5G networks, medical devices, and next-gen batteries, e.g., Samsung's ultra-fast charging prototypes, requiring significant silver, add layers of inelastic demand. Industrial use is sticky. Factories can't easily substitute silver, so they buy even at higher prices. This creates a floor under the market that grows stronger over time. In 2025, this demand helped propel silver's 120 to 168% gains, outperforming stocks and even gold in percentage terms. Institutions recognize that 2026 will see continued acceleration, especially with global clean tech commitments. Monetary and macro tailwinds. Silver as an inflation hedge and safe haven. Persistent inflation concerns. Massive government deficits. U.S. debt at $38.5 trillion plus and trillion-dollar annual shortfalls. And fears of currency debasement drive precious metals demand. The Federal Reserve's rate cuts in late 2025 reduced the opportunity cost of holding non-yielding assets like silver. Central banks' gold buying and emerging silver interest, e.g., Russia's programs, signals de-dollarization trends. Silver benefits as a more affordable alternative to gold, especially when the gold-silver ratio is historically elevated, suggesting silver is undervalued. Investment flows exploded in 2025. Silver-backed ETFs saw record inflows, 130+ million ounces, and institutional shifts, e.g., JP Morgan turning net long with massive holdings, confirm the trend. Smart money rotates into silver during low-yield environments and geopolitical uncertainty. 4. Institutional positioning and quiet accumulation. Major players aren't broadcasting their moves. They accumulate discreetly to avoid driving up prices prematurely. Examples include banks like JP Morgan holding hundreds of millions of ounces, firms like Sprott highlighting deficits and industrial growth, record ETF inflows and physical trusts. This quiet buying often precedes explosive moves, as seen in 2025. Institutions position early because they have long horizons and access to physical markets. Price outlook for 2026. Bullish consensus with upside potential. After 2025's breakout, silver up 120 to 168%, breaking 1980 highs. Forecasts for 2026 are optimistic. Conservative averages, $55 to $65 per ounce. Bank of America, metals focus. More bullish, $70 per ounce. 100 plus, with some analysts eyeing triple digits if deficits widen or squeezes occur. Extreme views. Potential for $100 plus tests as supply shocks hit. Volatility is expected, pullbacks possible, but the structural setup favors higher lows and new highs. Silver's dual role amplifies upside in bull markets. Why now? The asymmetric opportunity. Smart money buys when the story is clear but not yet mainstream. In early 2026, with deficits entrenched, industrial demand inelastic, and macro hedges in play, silver offers high conviction upside with limited long-term downside compared to equities or fiat. Risks exist. Economic slowdowns could temper industrial use or sharp corrections from overbought conditions, but fundamentals point upward. The quiet accumulation isn't random. It's strategic foresight. Those positioning now may capture the next leg of what could be one of the most significant commodity cycles in decades. Whether through physical bars, coins, ETFs, or miners, the message is clear. Smart money sees silver not as a trade, but as a generational shift in value.